Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, October 18, 2022, starting with our economic release spotlight. So we focused on Europe and Brazil in our leadoff morning note today. The latest batch of data out of Brazil are confirming at the margins of our Goldilocks grid model projections for the U.S. economy. So Goldilocks is where growth is accelerating on a trending basis, inflation is decelerating on a trending basis. We got the monthly GDP statistic from August accelerating 90 basis points to 4.9% year over year. That's the fastest print we've seen since July of 2021. In Europe, we saw both the German and ZOO expectation surveys improve from very bombed out levels in October. Eurozone up a point to minus 59.7. Germany up plus 2.7 to minus 59.2. These are extremely bombed out levels. And it's our view that these data don't represent a bottoming of European growth, hard data from a growth perspective, but rather sort of an inflection to negative from a third derivative perspective, i.e. European growth is still slowing, but it's not slowing at an increasingly accelerating rate at this point, which makes sense. They're seen to have their energy crisis kind of under control, at least for this particular interval in time. Check back with me in 6-9 months from now. But anyway, I don't know that there's much to do here. We run a variety of models to sort of identify trading opportunities from both a systematic and valuation perspective. And with respect to valuation, markets pretty much have this right. You got Brazilian equities, Brazilian real, both overvalued, European stocks undervalued, euros undervalued. So the market's definitely kind of assigning the appropriate premium and discount multiples to these assets. The one thing I call out is German stocks are still pretty expensive on a relative basis. So we would definitely maintain underweight exposure there. It's a pretty consensus short idea, European and UK stocks broadly. I think the Bank of America Fund Manager survey was out this morning. Damn thing's they've been max bearish. Their indicators have been max bearish since March. And that's obviously not been, particularly useful to anybody managing risk. I've said this all the time. You hear me say this on this channel and throughout all the various media platforms that we speak on. But sentiment is not positioning. Positioning is one thing. You can fade positioning at these particular intervals, like in and around OPEX, et cetera, to take advantage of some of these tactical trading setups. But sentiment is sentiment. Sentiment doesn't mean anything. Sentiment doesn't cause the market to go one way or another. Sentiment is just a reflection of what's already happened in the markets. Anyway, shifting gears to my Longbow dashboard, we'll start with going down global macro, and then we'll shift gears to identifying some tactical trading opportunities for those of you who like to take advantage of this, particularly in the option space, where I think a lot of these setups can be best monetized rather. So going down the list, Bloomberg Dollar Index, that's still bullish in the middle of the range there. Gold, that is still bearish, also in the middle of the range. 10-year Treasury, that's still bullish, again towards the upper boundary of the range, but not quite there. You got about 18 basis points of upside there. S&P 500, that's bearish. Got upside to where we have upside to right around 37.75 on the S&P. So let's definitely keep that in mind as we sort of head into OPEX. Maybe you see 3,800. We'll check back tomorrow. Maybe you see 3,800 or so thereabouts. I happen to think we're probably going to kiss 3,850 before we head back down. But that's neither here nor there. That's a fundamental view. VIX is still bullish. In the middle of the range there. NASDAQ 100, that's bearish, towards the upper boundary of the range, not quite. Russell, bearish, short-term neutral. So that's something to call out. We've seen this divergence throughout the year, something we've talked about in our research all year since going back to January, which is we're experiencing effectively the unwind of the NASDAQ tech bubble that we saw in 2000 to 2002. And as a function of those outflows from digital economy names, mega cap FANG type stocks, both then and now, we saw rotation into small caps, a rotation into value. And that's exactly what we've seen. If you look at our four horsemen of market risk, rather, small cap, mega cap ratio has been neutral for most of the year, as well as the value to growth ratio. So the market continues getting the message that a lot of market cap has to come out of these mega cap digital economy exposures over the next 1, maybe 2, 3 years and into small cap and value, where a lot of the natural resources type companies are hodled. So that process is going to be ongoing. It's not going to happen all overnight. If it did happen overnight, you'd see S&P 2,500 over in a heartbeat. But I do believe this is a durable trend that we're observing. So the reason I brought that up is because we've seen the Russell 2000 actually outperform on a very immediate term basis, as evidenced by the neutral signal there. But anyway, get into Bitcoin, Ethereum, both bearish, both roughly in the middle of the ranges there. Shanghai bearish, that's towards the upper boundary of the range there. Looks like it wants to try to push higher. It's kind of kissing the upper boundary of the range. We'll monitor that because again, we got some fundamental news coming out this week from the Chinese Communist Party's party Congress, tripling down on zero COVID. Tripling down on the drive to reunify Taiwan. We're still waiting to see if there's going to be any incremental stimulus, particularly from the fiscal policy front, because it's very clear from our research that China's PBOC is handcuffed from a monetary policy standpoint perspective, unless, of course, they want the yuan to get lit on flames and really start to soak inflation problem in the mainland China, which we don't believe they're willing to do. Bearish crude oil, still bearish, getting it roughly in the middle of the range there. Ag, bearish, still in the middle of the range. And then industrial metals, that is bearish, getting close to oversold signal, more or less an oversold signal, industrial metals. So if you've been short things like nickel, copper, aluminum, palladium, etc., definitely pay attention to this. You might want to be covering some of those shorts. And then lastly, getting into my global macro dashboard, where we're sorting everything by odds, so upside versus downside. There's about 300 ETF exposures in this tab that I put together for you guys to help you sort of identify some very tactical trading setups on any given day. So definitely, nothing really signaling overbought here. You got European financials getting there, and I suspect after the market opens, if we continue to trade positively during OPEX, we're going to get an overbought signal in European financials this week. Short European financials with impunity. If we get that overbought signal, I'll flag it on this program. But oh my God, there's just few assets in the world scream poor, more as poor to me than European financials, just given our grid model outlook from a fundamental standpoint. And then lastly, kind of scrolling down to what's most oversold here. So we got a lot of commodities oversold. We got nickel here, that's oversold. Let's see, coppers, that's oversold as well. Nat gas, oversold as well. Got soybeans. I see soybeans in there. Let's see, base metals. We talked about that a second. Soybeans. Yeah. So you got a lot of commodities, cocoa, palladium, etc., corn. So there's been this big risk off move in commodity prices, and that's very appropriate. We've done a lot of research on what happens on the other side of inflationary peaks, both in the economy and in financial markets. Obviously, commodities tend to be one of those things that lead to the downside from a financial market signaling standpoint. But again, as we all know, markets dance. They don't go anywhere in a straight line. They like to dance. So be careful. You've been short commodities. It's been the appropriate trade. Certainly, if you've you could probably buy them for a trade here. If you're sort of looking to position for something into OPEX. But again, I think we're running out of real estate to really chase these bear market rallies at this particular phase of the game from our researchers' perspective. So with that, Darius Dale presenting our macro minute for Tuesday, October 18th, 2022. Everyone have a wonderful Tuesday. We'll catch you back here tomorrow. Cheers.